Welcome back. Now, changes to the Pension Funds Act will allow funds to invest 45% of its assets offshore. While this widely is welcomed, there are some concerns. Financial services firms are warning between 6 and 800 billion rand could flow out of the country. Let's discuss what this means for you and your pension fund with Stanlib's Kevin Lings. Kevin, good to have you. Thank you so much for your time this morning. Let's talk about the meaning and what this actually means and some of the concerns perhaps that you share, particularly when it comes to the billions of rands that could potentially flow out of the country.
Morning, thanks a lot. Well, obviously the change in the exchange control generally is a good thing. You want to open up South Africa to as much international investment opportunity as possible. And obviously that's good for pension funds. It's good for investors because they clearly have that ability to move money offshore and equally move money back onshore. So the change in the current pension fund rules effectively allow pension funds to take more money offshore anywhere they want, right? So previously, there was a limit in place with regards to how much you could take offshore across the world, and then a certain limit applied to investments within the rest of Africa. And what government has said is they combined in those two limits into one limit of 45%, which means that pension funds can then take their money and place that anywhere in the world. And clearly, pension funds will be using that much more actively. That hasn't really happened, even though the legislation was put in place or the announcement was made back in February of this year. There has been a lot of turmoil in financial markets, and I guess investors have been a little bit hesitant to utilize all of this allocation and simply take the money automatically offshore. But that is the underlying dynamic. And so over time, pension funds could move substantially more money offshore if they chose to do that. And the amount would vary, but yes, a few hundred million certainly could move.
Yeah. I mean, it seems that this, of course, is what local asset managers had welcomed post the Finance Minister's 2022 budget speech. Do you think government had your reasoning, these unintended consequences in mind? Were they considered enough before these changes to pension fund, regulations were actually proposed?
That's difficult to answer because I must say the investment industry was caught out by it. It didn't expect this announcement, and it certainly went way beyond what anybody was anticipating in terms of further exchange control relaxation. And so this was a big step forward, if you like, and obviously it has provided the industry with a huge amount of flexibility, which is to be applauded. There's nothing intrinsically wrong with that, and it gives investors a lot of choice as to where they place their investments. And it would, for most people, eliminate any concerns around any exchange control rules and being confined to only investing in South Africa. Clearly, though, it occurs at a time when things are more constrained, right? So the South African economic environment is under pressure. The rand has been under pressure. And so it does open up the risk that at a critical time, more money flows out of the country. And clearly, if all of this money was utilized and all of this money left, it would put the currency under more pressure. It would obviously create more concerns about imported inflation. It would potentially add to the Reserve Bank's concern about raising interest rates. So there are some, I guess, short-term unintended consequences that could flow from this. But in the bigger scheme of things, in the longer term, is it a good move? Yes, you have to welcome this type of relaxation. It's what the industry's been asking for. And as I say, it now eliminates any real worry that your money is trapped in South Africa, which for many years was a legitimate concern.
Right. Kevin, with that being said, could there have been a better alternative to this other than, the approximately 8 billion rand potentially flowing out of the country? Could there have been a better option or, a resolution that the country could have taken? Yes, we've acknowledged that it is a good move. It has some consequences, but could it have been another alternative?
Well, I guess the alternative would have been to have a more gradual approach to it and phase it in over a period of time, and that way allow for the adjustment to be more systematic rather than a potential significant outflow risk. That would have probably eased any concerns, both for businesses in South Africa that want to perhaps have that money in South African hands rather than flow internationally, and therefore be able to adjust to that. And I guess for investors, they could have anticipated then a longer term horizon in terms of the speed at which these changes are made. So you perhaps could have phased it in at a slower pace. It's also caused concerns in the rest of Africa because one of the rules was that you could take money offshore, but 10% of that money could then only be invested in sub-Saharan Africa. And for some of those investors now, they run the risk that that money is taken away from the Africa investment and perhaps moved to Europe or the United States or somewhere else, and their businesses come under pressure. And we've heard those concerns, and those are legitimate concerns. So it could have been done, I guess, more gradually, more with a lot more forward warning so that businesses everywhere could adjust to it. And as I say, the industry was caught off guard. It didn't expect this bigger move to be announced in the budget.
Well, I appreciate you speaking to us and clarifying it for us. Chief Economist at Stanlib, Lings, thank you so much for your time.